Let's start with the positive. What went well in the quarter and contributed to the beat that you experienced?
Yeah, look, we had a really strong quarter, right? So revenues were up 36%. Profit was way above what we had indicated it would be our profit expectations. That was due to slightly higher gross margin, but also SG&A control, and obviously in the quarter, in the first quarter, we had a partial year of quarter of HEYDUDE from the year before. We purchased HEYDUDE in last year on February 17th. And so that gives an outsized revenue growth. But still, if you put it on a pro forma basis, our revenue growth was exceptional. So what I think we can take away from that is our brands are performing really well. The consumers have high demand for our brands. We can see that on a global basis. And some of our focus categories where we're looking to drive growth and looking to attract new customers, such as sandals, and also some of the focus we put on Asia is really working well.
Yeah, really interesting stuff there on China and other I want to get to. But let's talk about the guidance, because the way that I was looking at the numbers, it looks like revenue guidance was a little soft, but earnings guidance was very light. And so are there higher costs in the business? Is it the cost of that HEYDUDE acquisition? What's going on the cost front?
Yeah. So I think investors are definitely focused on Q2 guidance, right? But let me first start. What we actually did was we raised the full year guidance, right? We're going to grow double digits, and we raised the growth rate that we anticipate for the year. We also raised our profit expectations in terms of, we previously provided 26% profit. We said we're going to be between 26 and 27%. And if we look at the full year, we're going to grow double digits. We're going to have incredible levels of profitability. We're going to have very strong cash flow. We'll further improve our balance sheet by paying down debt. And so I think it's a great picture. I think what investors are focusing on is that Q2. And really what's going on in Q2, it's not a softening of trajectory of our brands. It's really about compares to last year and pipeline fill for HEYDUDE. So if we focus on last year for a second in Q2, because of the Vietnam factory closures in 21, we had light shipments for wholesale in Q1, and a lot of that pushed to Q2. So we're up against that from a Crocs perspective.
Sure.
And from a HEYDUDE perspective, we're up against pipeline fill, where we've shipped a lot of brand new customers, very large amounts of product to stock their entire chains, which was hugely productive for the broader distribution of HEYDUDE. But it's super hard to comp that this year. So It looks like we're slowing down dramatically. But if we focus on consumer takeaway, it's not slowing down at all. So I think that's what the street is getting a little bit sideways on. And in terms of profitability, look, I think last year we had a 30% EBIT margin in Q2. We're obviously not going to comp that. That was due to really buying HEYDUDE and being able to ship a lot of product very quickly, but we hadn't had the time to build the infrastructure, which we knew we needed to build within HEYDUDE. And frankly, that infrastructure is what's going to allow us to grow that brand, hugely over the next period of years. So I think it's a little bit of an overreaction. We feel super confident about our year and super confident about the long-term trajectory for our company and for our brands.
So is it fair to say that you have any concern about higher expenses? When we look, if there's one stock theme this year, it's that efficiency is being rewarded. And what would your message be to investors who are saying, okay, we like the trends, we like the launches, we've got a lot of good things going, but how do you become literally more efficient? What's on the table? What's not on the table?
Yeah. So I have no concerns about our expense base, right? So we will have more expenses in Q2 than we had last year, but I think those are appropriate due to our growth expectations for the brand this year and the brands in the future. I would point out that our level of profitability between 26 and 27% EBIT margins are extraordinary in our industry. There is nobody that's even close. If you look at all the public companies that trade, I don't want to call them out specifically, but there's nobody that's even close. So the level of efficiency we have in terms of profitability and cash flow generation for this company is extraordinary. So I feel very confident about that. All
right. You have strength in China, France. I mean, are Crocs going to be the new Birks if you get this sandal launch going right?
Yeah, I think, we're obviously already 3 times the size of Birks, right? So I know Birks is a private company, and most people don't know how big it is, but I could tell you that we're 3x the size of Birkenstock. So, and globally distributed. So, the sandal business is super important for us. We've got a very strong franchise in clogs. That's what you know us for. That's what every consumer, when you show them the classic clog, thinks about Crocs. But the sandal business is a $30 billion global business on an annual basis.
Yeah.
We think we can penetrate that very significantly and build incremental business there. And we've been working on that for a couple of years, but 65% growth in sandals in Q1, 45% growth over the last 3 quarters, I think puts us, firmly on that trajectory.